How is everyone doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. In today's episode, I wanted to talk about commercial real estate. What are banks doing right now to kind of deal with their exposure to commercial real estate? How are they addressing some of these issues? We're going to look at two articles today, one from Bank Director and one from S&P Global Market Intelligence, to try to give us an update on what's happening here. So with that being said, let's get into the first article. So banks start to take their lumps to address commercial real estate exposure. So several banks have raised capital to help them purge commercial real estate loans. More are expected to follow their lead. So this article was written by Paul Davis, who's a contributing writer. And the basis of the article here is they're going to talk about the raising of capital, but then as we go down, we're going to talk about pressure points. And then as a result, more banks looking to mitigate their exposure. We're going to get into sources of the pressure and then kind of challenging strategy. And so we'll go through that and then we'll get into the next article. So basically it says here, several banks have raised capital to tackle their commercial real estate concentrations despite the hit to shareholders, and many more are expected to follow their lead. So New York Community Bank, which I've detailed in a number of episodes, they're kind of going ons in Hicksville, New York. First Sun Capital Bancorp in Denver and First Foundation Inc. in Dallas have all turned to investors as part of broader plans to purge commercial real estate related loans. More banks are having difficult discussions with investment bankers and potential investors about absorbing any hits tied to selling concerning assets, investment bankers say. We're hearing, seeing, and partaking in conversations with banks that are feeling pressure about CRE concentrations. Says Matt Shields, a managing director and head of FIG Capital Markets at Performance Trust Capital Partners. Raising defensive capital unlocks the ability for them to be proactive, solve the problems in their balance sheets, and get earnings to a better place over the long run, Shields added. Okay, so that's true. So let's talk about some of the pressure points. A rapid increase in interest rates has raised concerns about credit quality in CRE books as banks also deal with the low yields from loans made at historically low rates. A post-pandemic decline in the need for office space has created added challenges. A more intense focus on CRE is the latest in a series of challenges associated with high interest rates following last year's liquidity panic and banks' ongoing efforts to manage their underwater securities holdings. Okay, so there's a couple things to unpack there with that. So first of all, credit quality. Again, I want to stress the fact that a lot of your problems right now are, you have four major segments in commercial real estate. You've got apartments, you've got industrial, you've got retail, and you have office. The area with the big problem right now is office. It's been the office since the whole remote working thing started during the pandemic and is carried on. That's really killed basically office buildings because a lot of companies have looked to downsize, reduce their leases, move to better space. If you're in like a class A, or I'm sorry, if you're in a class B or class C office building, a lot of people have wanted to move to nicer accommodations, and they'll take a smaller space in a class A building, meaning that leaves kind of the B and C players to, basically struggle to keep their rent roll intact, their tenants up, so to speak. So you've kind of got all that going in there. Now, here's the other interesting thing. It says, as banks also deal with the low yields from loans made at historically low rates. So what does that mean? That there's a lot that goes into that. So think about it in terms like this. If you have a commercial real estate portfolio, and if I've got 100 loans and I made all those loans at, say, 4%, and now the market is at 7%, that means that basically all those loans are now underwater because they're below what the market is currently bearing. So you need to start generating some new loans at the 7%. And you also need to, whenever those existing loans come up for renewal, you need to basically reprice them at 7%. Not that you're not going to renew them, but the problem is with the deterioration in rent rolls and the additional cost of the debt, with the higher interest rates, that's kind of like a double whammy on a lot of these properties, meaning their cash flows are now underwater, meaning that, now, if they struggle to make the mortgage payments, now you've got properties that could go into default, go into foreclosure. And so it's a whole issue here. So there's a lot of, interesting things there said with the pressure points. So, and then as a result, more banks are looking to mitigate their exposure. So New York Community Bank got the ball rolling earlier this year, raising roughly $1 billion by selling securities to a group led by former Treasury Secretary Steve Mnuchin. Now, I would say that's interesting because that was more of a bailout. That was really more of a bailout. They came in. They basically had no choice because New York Community Bank would have gone under had they not come in with that $1 billion. That was not your like normal capital raise. And then it goes on to say the $112 billion company, which has exposure to rent regulated apartment loans in New York City, expects elevated loan loss provisions over the rest of the year. Okay, but let's go on to the next bank. We kind of know about New York Community Bank and their special issues, but let's look at meanwhile, the $7.8 billion First Sun Capital Bank Corp increased the capital raising target in late April for its pending purchase of Home Street in Seattle by 34% to up to $235 million. The $9.5 billion Home Street is expected to unload about $300 million of commercial real estate loans as part of the deal. More recently, $13.6 billion First Foundation announced in early July it had sold $228 million of securities to a group led by Fortress Investment Group, which should reduce its ratio of CRE loans to total risk-based capital from 519% to 436% and allow it to sell lower-yielding multifamily loans. We have to take some of our multifamily loans and shift them into available for sale, take a mark-to-market. CEO Scott Kavanaugh said during a conference call to discuss the capital infusion. We want to be very thoughtful about the process. We believe we got a pretty clear path set out and we're working on it. So, yeah, going from a 519% ratio to a 436% ratio, yeah, they're bringing it down, but the threshold there is 300%. So if you are over 300%, you are considered highly concentrated in commercial real estate. And so yeah, they're kind of making a dent, but they're certainly not solving the overall problem there. So just, kind of keep that in mind as you're thinking about this, but also too, I mean, they talk about, offloading real estate. Well, I have reported before in other episodes, where are they offloading this real estate to? Well, they're selling it to private equity funds and they're selling it to hedge funds. They're selling it to, what's known as private lending. So like I said, I'm fascinated to see how all that plays out. I don't think it's going to play out well because you're basically selling bad loans to private lending. And then what happens to those guys when those loans go bad and they come looking for a bailout? So, but anyway, okay, the capital infusion also ushered in fresh leadership at First Foundation, where veteran bank executive Simon, if I'm saying his last name right, Lagomarsino, was named the bank's president. And then let's see here, sources of pressure. So banks of all sizes are facing regulatory pressure to get CRE exposure down, says Scott Hildebrand, chief balance sheet strategist and head of depository fixed income at Piper Sandler. Banks are clearly looking at all the levers they have so they can address capital and improve future earnings. Shields said directors and investors want to see CRE concentrations go down, and the heavy hand of regulators is starting with the bigger banks, but it will trickle down to those as small as 100 million of assets. Of course, it is about more than sheer asset size. Regulators scrutinize banks with CRE concentrations of more than 300% of total risk-based capital, like I just said. If outstanding CRE loans grew by 50% or more during the past 36 months, and then that ties in with the 100%. So you have a 300% ratio and a 100% ratio. The 100% ratio is judged by did your CRE loans grow by more than 50% in the past 36 months? And do you have, do real estate construction loans also equate into that 100%, formula? So, and then we get basically challenging strategy. Now is not the optimal time for banks to raise defensive capital. Raising capital to address loan concentrations can have quite a cost for the banks and for existing shareholders. At the end of the say, you get capital when you can, though it is a lot more expensive today than it was a year ago. It doesn't look great for existing shareholders given massive dilution. So, and then that's a whole nother issue with stock dilution. But there's no doubt the cost of capital, you go out to raise money, is a lot more expensive today because of higher interest rates. While most efforts have focused on common and preferred stock, industry experts said that some banks are considering issuing subordinated debt. So now you're kind of getting into the different ways that you can raise capital. I don't really want to get into all that at the moment. I really wanted to stress more on, what banks were doing to kind of address the commercial real estate issue with this. I'll get into the raising capital. I'll get into all that in another episode. Investment bankers, however, are advising banks to take a hard look at restructuring their CRE books, much like repositioning the securities portfolio. Banks that are willing to take their lumps now should produce better earnings over the long run. Unlike underwater securities, CRE presents the added concerns about credit deterioration, creating a situation where even a well-capitalized bank could have issues if it overlooks potential problems. What happens if we have another bad credit cycle? Davis said even the banks that look like they have a lot of capital will have to deal with that. Shield looks at the reverberating impacts. Credit is the scariest thing because it can have the most vicious impact on your earnings and capital levels. That is absolutely 100% correct. I used to have a CEO that used to tell the entire lending staff that basically the only thing that could ruin the bank was bad loans. That was it. Basically, everything else can basically be, pretty much most other stuff can be dealt with. But bank loans can sink the bank faster than anything else. And so it was always drilled into me, asset credit quality, just, from a very, my first day, kind of working full time in banking, that was drilled into me. Asset quality. Okay, so let's take a look real quick this was an article from S&P Global Market Intelligence from August 5th. This is called "Many Top Office Lenders Continue to Dial Back Exposure." Many top U.S. bank lenders shrank their office real estate portfolios again in the second quarter. Wells Fargo, Bank of America, and PNC each lowered their exposure to the property sector on a sequential basis during the quarter, according to company filings. The three reported the largest office exposure in the S&P Global Market Intelligence analysis of U.S. banks that disclosed their quarterly office lendings as of July 26th. Citizens Financial Group and Truist Financial Corp, other top office lenders, also backed off in the quarter. The biggest step back among banks that reported office exposure belongs to New York Community Bank, no surprise there, which reduced its office book by 12.6% from the previous quarter to $2.8 billion in office loans. New York Community shed a significant portion of its office portfolio in the prior quarter as the sector shows signs of credit cracks. While most banks in the analysis lowered office lending balances quarter over quarter, some major lenders did not. Town Bank reported a 2.6% increase to $1.2 billion, or 10.8% of gross loans held for investment. Regions Financial reported a 4.7% sequential increase in office exposure to $1.6 billion, primarily as a result of three existing credits totaling roughly $70 million being reclassified as office loans. Without the reclassification, there was no change. And it said Eagle Bancorp had the highest proportion exposure on the list, with office accounting for 12.9% of loans held for investment. And then it just kind of goes down here. It basically shows office outstanding exposure at selected U.S. banks. Obviously, no surprise, Wells Fargo, Bank of America, PNC, all at the top of the list there. I don't think anybody's surprised by that. Credit quality, signs of stress and credit lingered and worsened quarter over quarter for some of the top office portfolios as multiple banks raised reserves against them. Let's see. And then, office credit quality data at select U.S. banks. Again, just kind of listing through the top banks there. And that's what we got. So again, like I said, the biggest issue that remains is in, kind of the office market right now. But there's no doubt that, banks are looking for different ways right now to basically reduce their real estate exposure. They're either selling loans off, they're trying to raise capital, they're trying to restructure their commercial loan portfolios. I think that anybody that is sitting there with a lot, we've seen some kind of weird things in the commercial real estate because some projects have gone fine, some other projects have gone delinquent. I think it depends on what it is you're getting into. I think, construction industrial has really slowed down because you've had some vacancy uptick there because the mega industrial spaces are not in demand right now, as Amazon has kind of really pulled back out. And when I mean the mega spaces, I mean I'm talking about million square foot industrial spaces, 800,000 square foot industrial spaces. I think activity in the smaller range, like if you're under 500,000 in square footage on industrial, I mean, they still seem to be doing okay, even though the vacancy has ticked up a little bit there. Apartments showing a little bit of concern as the debt rolls, as we say in the banking business, as you roll the debt when your interest rate has to get renewed after you have, you can have a 3, 5, 7, 10-year loan that comes up for maturity, and you have to renew that loan, renew it at the higher interest rate, and kind of go thus rolling the debt, and it kind of goes on from there. So still some very interesting things happening in the commercial real estate world, and like they said, I think the big concern there is that even banks that are well capitalized, if they begin to see a significant deterioration in their commercial real estate portfolios, it could be bad. Now, and here's another interesting thing. What do you consider a significant deterioration? I could tell you that it doesn't take much, for a bank to go bad based on their loan portfolio going bad. Like, in other words, if 6% or 8% of a bank's loans in their portfolio go bad, that bank is done. Like, it doesn't take, like, I think a lot of people assume that you have to have this 30% of the loans or 40% of the loans have to go bad. This giant chunk of loans in a portfolio has to go bad in order to ruin a bank. That's not really the case. I mean, if you have basically 3 to 8% of a bank's loans go bad, that bank's done. So it doesn't take as much as perhaps people think, and thus why you have the scrutiny from regulators. So anyway, all right, we will absolutely continue to keep an eye on commercial real estate, but I hope everybody enjoyed this episode. If you did, please make sure to like, share, and subscribe, as that always helps the channel. Please leave your comments down below, particularly if you have any comments overall on commercial real estate. I'd love to hear it. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please make sure to check out the bankernextdoor.com, and I will be back with everybody again real soon. Thanks a lot.